The highest yielding Canadian bank ETF is not always the best. In fact, for some investors, it might actually be the worst. Why? Because of hidden strategies and tax consequences like return of capital that can seriously impact your long-term growth. Today, we're going to war. We're comparing the 5 titans of Canadian bank ETFs. We're going to cover the covered call plays of ZWC and ZWB. We're going to talk about the leverage giants of HCAL and HMAX, and the one that tries to do it all, the bank ETF by Evolve. I'm going to show you what's really under the hood of each one so you can decide which strategy is right for you. You all gave me an overwhelming response to my HHIS ETF deep dive, and this is the natural next step. If you appreciate an accountant digging through the details to save you money, hit that like button to help the channel and to subscribe for more. Let's first start off by looking at BMO's ZWC, which is the BMO Canadian High Dividend Covered Call ETF. ZWC has a management expense ratio, or MER, of around 72 basis points, and the distribution yield is just under 6.5%. It invests in a diversified portfolio of mainly Canadian dividend-paying stocks and writes covered call options on approximately 50% of its holdings to generate income. As you can see, nearly 40% of this ETF is invested in the big banks, but you also get exposure to other big names like Enbridge, Canadian Natural Resources, Canadian National Railway, among other non-financials to round out the offering. Next up, let's talk about ZWB, which is the BMO Covered Call Canadian Bank ETF. As the name suggests, this ETF focuses specifically on the Canadian banking sector, holding the big 6 banks, and also employs a covered call strategy on a portion of its portfolio. ZWB actually has a slightly lower MER of 71 basis points, so not much difference compared to ZWC. Its annualized yield is also fairly close to ZWC at around 6.4%, not too different. And of course, the top holdings are the big 6 banks. So here's my take on these two ETFs. If you are a conservative income seeker who's okay capping their upside potential for steadier monthly cash flow, then you should consider these two ETFs as part of your portfolio. Again, you are trading upside for steady monthly cash flow. Now, keep in mind that these two ETFs have actually not grown their dividends since inception. The biggest risk with these two ETFs isn't a market crash. It's in fact underperforming a strong bull market because of the covered call strategy in play, which limits your potential capital gains. Honestly, if you are looking for a total return to maximize total return, then you are just better off holding an index fund that replicates the TSX, because both these ETFs in particular have significantly underperformed the broader Canadian market. As a CPA, the first thing I look at when it comes to investments is the tax bill. When it comes to ETFs like ZWB or ZWC, or even the three we're about to cover, you have to know what you're actually receiving as part of their distributions. And that's where the T3 slip comes into play. Now, many of you from my last video were confused about this line right here, return of capital. Many think that it is extra tax-free profit. I can tell you it is not. Let me give you an analogy to explain what this actually means. Imagine you put $100 into a piggy bank. A month later, that same piggy bank hands you back $5. Did you make $5? No, you didn't. And now your piggy bank has $95 of your original investment because it just gave you $5 back. This is exactly what return of capital is. It is the ETF giving you back a piece of your initial investment. And I know it may feel like income, but in fact, it's just a refund of your own money. And because it's your own money coming back to you, that's why it's non-taxable today. That $5 refund we just talked about, it actually lowers your cost base for tax purposes. So now your cost base goes from $100 to $95 because you're given that $5 back. So what's the catch here? You'll eventually end up paying more in capital gains when you sell the ETF because you have lowered your cost. And capital gains is based on your sale of proceeds less your cost base. So lower your cost base, the higher your capital gains. And the higher your capital gains, the higher you pay on capital gains tax. And keep all this in mind that I'm talking about non-registered accounts. I'll talk about registered accounts later in this video. But when you receive profits or dividends in non-registered accounts, that is taxed today. Return of capital, that is tax deferred, meaning you won't pay tax until you actually sell. So the bottom line is this: if you invest in these ETFs and you hold them in a taxable account, then you have to track your cost base manually. That's on you. The CRA is going to come after you if you don't track it properly, so that is your obligation. However, if you hold them in a registered account like a TFSA, then it's all a moot point because these types of distributions are all invisible to the taxman. Next up is Hamilton's HCAL, which is different than BMO's ZWB and ZWC in that HCAL has no covered calls. Instead, what it does is simply holds the equal weight Canadian banks and applies the modest leverage of 1.25x. But the biggest red flag with this ETF, when you do the digging, is that the MER is exceptionally high for what it offers. The MER of 2.16, it is in fact 3 times more expensive than ZWB or ZWC. Now, if you're wondering about the distributions and the sustainability of those distributions, when it comes to HCAL, now while we see it doesn't apply the same traditional covered call options as ZWC or ZWB, a significant portion, roughly half of those distributions based on recent data, is still return of capital alongside eligible Canadian dividends. So the point is that even though it has a different strategy than ZWB or ZWC, the return of capital is surprisingly similar to those two ETFs. The point I'm trying to make with these ETFs is that yes, the income might seem appealing at the onset, but you have to go beyond the advertised yield. You have to go beyond the advertised income. You have to keep in mind the tax implications of return of capital, especially in a non-registered account, just as we talked about in the last section. So here's my take on this ETF and who this ETF might be for. This is for those growth-oriented investors who are bullish on the Canadian banking sector and those that want to amplify the returns and dividends coming out from the sector. Dividends have grown since launch of this ETF, so that's a positive sign, and it has also outperformed the TSX so far. So those are some of the things that I look for when I'm evaluating ETFs. However, I do want to caution here, the risk is also magnified. If the banking sector, for example, experiences a 10% drop, for you, if you're holding this ETF, your drop is going to be magnified by 1.25. So a 10% drop on the sector means a 12.5% drop for you. So just something to keep in mind. Now for the one that you've probably seen advertised everywhere, HMAX and its massive yield of close to 14%. This particular ETF holds a broader portfolio of Canadian financials and writes aggressive call options at 50%, but it does not use leverage and it has an MER of 80 basis points. In order to get that yield, what HMAX does is that it pays out a very large amount of, you probably guessed it, return of capital. Expect this to be a dominant component of your T3 slip, and that's why it's so critical you track your adjusted cost base. Again, this is only for non-registered accounts. If you're holding this in registered accounts, again, that's a completely different game. So here's my take on this ETF. A high yield is honestly meaningless if the fund is just giving you back your own money to advertise a higher yield. And that's why, again, the whole point of this video is you have to go beyond the advertised yield to uncover the hood on what you're actually getting back as a distribution. So if it's just handing you your own money back while the unit price of this ETF slowly erodes, you're honestly just better off tracking the TSX. But if you really want to hold this in your portfolio, then do not put this ETF in a non-registered account, stuff it in like a TFSA. So all the tax implications, all the manualness around tracking your adjusted cost base is completely eliminated. Finally, Evolve's Bank ETF, which tries to do it all. It holds banks, it holds life insurance company, uses covered call strategies, it has leverage, and for all this, you're getting an MER of 0.83. In terms of dividends and sustainability, this is probably going to be the most complex T3 slip of the bunch. Why? Because it's got exposure to everything. It's going to give you eligible dividends. It's going to give you options income. You're going to get a ton of ROC and the effects of leverage on the underlying portfolio. My take, this ETF is for investors who want a bit of everything. They want exposure to not only banks, but the life insurance companies that want exposure to leverage, that want exposure to covered calls. But keep in mind, complexity is its own risk. You have to be comfortable with two key components with this ETF. Are you comfortable with the capped upside from selling covered call options on this ETF? Are you also comfortable with the amplified downside because it also employs leverage? Is the additional complexity worth that extra yield? That's the key question you want to ask yourself before you invest in this ETF. I will give this ETF points for growing its distribution, going from 7 cents back in 2022 to now 11 cents per share in 2025. Honestly, it's always nice to see ETFs growing their distribution over time versus maintaining that same payout over multiple years. Because if it's paying the same, let's say 10 cents distribution for 5 years, that 10 cent has lost purchasing power because of inflation. And this ETF, in its limited existence, has done better than the TSX, but the sample size is honestly very small since it's only been around for a little over 2 years. So how should you consider these ETFs if you're trying to build a portfolio? Well, if you're a conservative income seeker, then maybe ZWB could be a fit for you. And if you're bullish on the Canadian banking sector and you want that enhanced growth, then you might want to consider HCAL or HCAL. But if you're looking for the highest cash flow, especially within a TFSA, then HMAX could be an option. And bank offers a little bit of exposure to everything, as we've talked about. It's got banks, it's got life costs with an enhanced yield to top it all off. Generally speaking, these ETFs could be an attractive option for income-focused retirees who value that monthly consistent cash flow over seeking capital appreciation, plus who understand the specific risks around each of these ETFs. Because you have to keep in mind, you're looking at covered call options, you're looking at leverage, you're looking at return to capital. You have to factor all that if you want these ETFs as part of your portfolio. However, if your primary goal is long-term growth and you're not nearing retirement, then you might want to consider more simpler options, especially if you're looking to focus on Canadian banks or the broader Canadian market. Then you can look at ETFs like ZEB, which is just focused on Canadian banks and equal splits, no covered calls, no leverage, just holding the big six banks in equal weightings, or something like XFN, which is a more simple, diversified Canadian financials ETF. And finally, a crucial reminder about tax consequences. If you have to hold HMAX or something like a bank ETF, or any ETF that has a high return of capital as part of your portfolio, then you are honestly undeniably better off holding that ETF in a TFSA where there are no tax consequences to keep track of. You'll enjoy that high cash flow without any tax consequences, plus just avoid the headache of trying to manually keep track of that adjusted cost base. So takeaway here is clear. If you are going to invest in high yield ETFs, don't just chase the highest yield. Don't just chase the highest distribution amount, but rather understand the strategy, the holdings, and the tax implications as part of an overall strategy. It's about building your financial future with intelligence, not just speculation. And it's that commitment to smart investing. That's exactly what this channel is all about. So if you've enjoyed this content and you want to see more of it, the best way to let me know that is in the comment section down below, or hit that like button, hit that subscribe button, because it lets me know you want to see more content like this, and that's the type of value-added content I want to deliver for you. What other complex financial topics are you grappling with? I'd love to hear from you. Let me know your questions down below in the comment section, because it's those type of comments that will shape my next video. That's it for now. I'll talk to you in the comment section.